Venugopal Garre, Managing Director with Bernstein, joins us now. Let's understand from him the global construct and what he's advising in clients in terms of the near-term dynamics. Venu, good morning. Thank you for joining us. The markets have done very well for themselves. What's next? Because some would argue and say that all the triggers in terms of macro, micro, inflation, crude prices, earnings, everything is played out. What's next which will propel the markets higher?
Yeah, thanks a lot. This is the most important question to answer now. I guess the call earlier this year was fairly easy. In fact, my own journey has been, as we discussed earlier, was that I upgraded the market in the first week of April to a buy, after being underweight for the first quarter of the year. Now, there was, of course, a lot of factors which drove that call of ours at that point of time, especially centered around the bottoming of the economy. Now, to a large extent, that's played out. So what we did just about 2 months back is we sort of reasserted our positive call, but then started to say that the broader markets will continue to do well, while the index perhaps will just float around the range. When I say broader markets, technically means everything around SMID. Now, the reality is, if you look at the last 1.5 months, we've started to see a situation where momentum in SMID has been fairly strong. And most of these themes and ideas are getting priced in quite quickly. The question simply is that from here, should one sort of start turning to really negative on the market? But when I look at the broader global construct, our thinking was to still say generally positive on the markets. But at the same time, the argument for us was that things like, global commodities, they're okay at this juncture, not really necessarily a negative driver for India. More importantly, I think global growth will still moderate through the year. There are chances of that. And primarily means that we benefiting from that as a country will still remain as a theory. The second part is, at least from what I look at is the GDP construct. It will be a very first half heavy, especially given the fact that we are preponing a lot of these government spends. So to that extent, I'll probably say that, when it comes to weakness in macro parameters, probably we'll start seeing that a bit in, let's say, December month or the March quarter, where things will be weaker heading into elections. So to that extent, we'll continue to get some positive momentum in the economy. So there's no reason to be outright negative on the markets at this juncture. So what we do in such a situation where the domestic economy is okay and global economy is actually helping us rather than anything else, we then don't really change a call. We allow the market to basically, run its course. Given the fact that we don't really see too much of downside risks at this juncture. So that's the way we are essentially following. Is no change to our Nifty targets, pretty much in this range. But I don't call myself as a seller of the Indian market at this juncture.
Not a seller, and you do believe that the downside is capped, but is Venu the upside capped as well?
Upside is purely a function of time frames right now. So if you were to look at let's say another 8-9 months, what is a big event in India, right? We are all going to be talking about elections. You probably started seeing a lot of reports out in the market as well, right? Centered around election activity, who will win. I think the biggest touch point for India is elections. And we really don't know what's going to happen in this, sort of, parliament session, which will also be called later for this month. If we're going to be doing anything around, state election, central election merger, how does the market look at that, and especially around the prospects of the current government coming to power. Now, one thing is very clear to me that if I were to look from here till the next 8-9 months, if the same government remains in power, it's a powerful enough driver for the markets, which is that, that more momentum which comes in because people get comfort that, hey, for the next 5 years beyond that, we have at least clarity on policies. So markets are going to be much higher in June, July next year than they are today, right? And what could, of course, mean that a lot of these large cap laggards, you haven't really seen financial sector being significantly up year to date. Neither has been, some of the largest stocks like Reliance, for example. The market is up, 6-7% year to date, right? So especially given the fact that large caps, quite a few of them haven't moved. So timeframes with this being the one important touch point as to what happens with respect to the political events and macro prospects post that.
Okay. If markets are trading above the historical valuations, do you think the near-term returns will get compromised, whether it is before election or after election? Ultimately, it's the price point which matters. So if one looks at the current price point, factor in all the economic growth which currently is projected, do you think now we are in for, let's say, low single-digit returns or at max early double-digit return in terms of in 3-year compounding?
I think probably 3-year compounding, perhaps not. And the reason being that, if I look at the two main things here, I think it's also construct of earnings cycle. I think most of consensus is looking at mid-teens numbers in terms of earnings. And, as I had broadly indicated earlier as well, a lot of the earnings construct is driven through margins rather than largely through top line growth. And a part of the theory that I see for the market is beyond politics is the fact that we're still early cycle as an economy. So I do believe there's a room for a decent cycle shaping up in India over the next 3-4 years. So what it means is that from a purely CAGR perspective, we could be probably higher than the low double digit number if I take a 3-year view. The problems and challenges are more about the next 6 to 8 months. Are you going to generate 4-5% returns from here, or probably be flat or down? I'm more at an index level in the flattish sort of a camp at this juncture for the near term at least. But at the same time, I do believe that market is going to chase themes, chase some of these small caps, where people don't really bother about valuations, right? Which is more thematic. In given that these companies can disproportionately see earnings rises as well. So bottom up picking perhaps important to a large extent. At this juncture, if I take a 6-month view, and SMIDs, even within that, you're just chasing momentum in certain places, but then you don't really have a valuation anchor in place. But on a 3-year view, I think I would still want to be believing that we're going in for a decent return journey.
I was just going through one of your reports, Venu, and while it's about financial inclusion, and I think that's the India of the last decade, it's also about the infrastructure growth, which you also talk about in your note. How can investors stand to benefit from it? And do you think this is the theme which is going to be prevalent and dominant in the next decade too?
Yeah. So even though I didn't want to ring fence myself to a decade terminology, I was actually trying to avoid that in a lot of my reports. But the reality is the future, firstly on the financial inclusion thing, is a very important variable in my view, and it is going to help, in my view, the entire financial ecosystem. I'll tell you the broader prospects here. See, ultimately, the broad anchor of financial inclusion is digitization, right, of all forms, which primarily means that if you're able to succeed in the second phase of digitization, which is ONDC or OCEN, which some extent sits on the ONDC network as well, you're able to primarily get a lot of data on small scale companies, retailers. You can do a lot of B2B work as well there. Now that primarily is the basis on which you're going to be giving microcredits across the board, right? And that point of time, even larger banks can participate through those channels, right? So which means for the economy, you're getting low cost funding, lower cost funding than you would normally do for that set of an audience. It's a pretty large audience. So that's actually good for the economy to a large extent. And for financial sector at the top end, and they couldn't really have to tap that opportunity, right? So they will be able to tap that opportunity, which means credit growth could also sort of look up. So this is one broad construct of what I basically see digitization and financial inclusion playing over a period of time. And this is across the board financial stocks, right? So this is not just about one of the consumer tech digital companies on the fintech side that we actually have a buy on as a house, but this is not just about that. We're looking at beyond that. The second part, very quickly on infrastructure. See, a lot of infrastructure has been government dominated in the last few years. Part of that was actually the right approach. We've been writing on this even like 5-6 years back, that the historic infra models of PPP actually were very faulty in nature. So to some extent, the heavy lifting has been done by the government. And I believe that to a large extent that will continue. Only thing is the contours of infra spend will probably shift towards power sector, where a lot of private participation would essentially come in. So if at all private sector participation plays in that, but things like roads or railways or even metro, they have to be government dominated. That provides opportunities across the board. Honestly, cement is one aspect to it, but then you have large construction companies as well. One of the largest ones, I still believe, has a lot of room to see returns from here, from a stock point of view as well.
Right. Venugopal, hi, morning. Given the fact that you have spoken about how India has already seen a focus on infrastructure and manufacturing, what is the way forward? Because it needs to be emphasis, as per the report, on a consistent and a dedicated push. How critical will this be to our growth?
Yeah, see, one of the key things I want to highlight is, they would probably have seen another of these, detailed thesis of ours on India, China. I mean, it's a very well talked about topic, even in history, but probably more pertinent at this juncture as well. See, consistency of policies is a fairly important variable for us seeing through, policies getting executed. And that's where I guess historically we've had some challenges. A part of that was because we used to be very top-down policy making, but execution used to be left to a lot of other things, including states or private sector, which never really played out the way we would want it to play out. Now, the reality is, at least from what I, understand at this juncture, meeting government officials, trying to see what corporates are doing, at least to large extent, there's a consistency in policy and execution to an extent. Yes, there have been failures. There have been probably slower pace at which manufacturing could shift because to an extent, we're in a very different era of globalization as well, with quality globalization. So that also doesn't make it very easy for us to, get outright overnight wins. But the reality is this, that let's say next year we have a change of government. Uh, how will policies change? Will manufacturing get the same love that it was getting earlier? Will infra policies be changed from government to private and then we'll get into mishaps again? We really need to watch that honestly. So that's like the unfortunate reality of India versus China. China is able to control its land, labor, resources, policies, and financial sector very deeply, through the political system they have. Right? We don't want to really go to that political system, but the reality is we have our own limitations as a country.
The relative difference between India and China is at its peak. Underperformance and outperformance, that is adding to this relative outperformance largely. Do you think somewhere the risk reward ratio now from global asset allocator is in favor of China? So India may be a great story, but it is like saying I'm buying gold at the price of diamond.
I'm short gold, by the way, but just to put in another perspective.
And long diamonds.
Long diamonds on a very different note, but short gold for sure in the India portfolio. But just to put in perspective, this is a very important question you raised about the flow aspect to how India is looked at versus China. See, honestly, China is a much bigger weight, in the index as well, and people globally would love China to do well because it's going to help their portfolios as well. I don't think there is a major rebalancing which has happened towards India. Okay, so if we had seen major rebalancing, we'll have seen $50 billion of flows, not like $5-6 billion of inflow. So that's the fundamental reality. We get to see that balance change. Number two is that, valuation gap is very high right now, which is India, of course, is, a relatively higher valuation versus China. But if you were to generally look at history, India's earnings growth has been significantly higher than that of China. It's actually India's earnings growth historically has been the highest across the world, right? So that's the reason why India tends to be trading at higher valuation. And second thing is governance, which is an aspect where, India in general, Indian companies are much better. That's the fundamental reality construct of basically the index as well. Now, but at this juncture, what I do see is that the global investors, I have never seen them as negative on China that, it was no longer about cyclical issues. They're talking about structural issues primarily. And they seem to be more confident about those structural issues than they were a year back. So that makes me a bit, sort of worried that, are people too negative on China and we could see a bounce back, because of that factor, especially for perspective. It could happen, but does it really matter is my question, because see, a lot of us tend to take 12-month, 24-month calls by nature. So it doesn't really bother me, as long as India is fine. But I don't disagree with your opinion on valuation gap and trading rallies from time to time.
Okay. You mentioned banks at the beginning of the show. I'd like to throw in IT. Now, IT, whatever could go right has gone wrong for, whatever could go wrong has gone wrong for IT, whatever right could go has gone wrong for banks. And that, some would say, is the challenge, right? For banks, incrementally nothing new will come. For IT, incrementally nothing bad will come. And that's how markets move. I mean, they're pricing in all the good news for banks and they're pricing in all the bad news for IT.
Okay, so that's an interesting one. I would sort of highlight that as far as financial sector is concerned, I don't think the story is over. I mean, this is after a long time. We have visibility on credit growth, which could last for a few years, decent credit growth. And, credit quality, which is essentially very, very strong. And I also believe digitization is going to be supportive to the financial sector rather than being disruptive. All of that is in place. And I don't think these stocks have essentially done well as well. And they're not like, changed too much. They're not too costly as well based on the kind of growth profile that we expect over the medium term. Yes, they could have, those tactical issues around NIM, around rate changes and all. But I think actually that is priced in. So that's the way I look at financial sector. I think the story is not over. In my view. But if I look at IT sector, I mean, I don't know whether we should say that everything is priced in yet. It's a different thing that we are actually overweight IT as well. So, but then we were overweight IT very nicely. We had actually creeped into IT overweight and funded that to consumer tech than pure IT services, which is when we realized that, you know what, are going to be some challenges which we can't really quantify. So we are more overweight in consumer tech within IT, right? So that's where we our weights are. But looking forward in the next 6 to 12 months, I would probably say that, look, end of the day, the worries that people have, especially around global growth and global meltdown, have been proven wrong to some extent, especially about global growth, right? Things have actually held up fairly well, even in the US. And we are not going to be seeing the GFC kind of a situation. So at some point of time, the market realization would also be that, hey, things like AI are actually going to be positive drivers. They won't be initially anyways, in terms of, order flows and stuff. So once there is a certainty of bottom, that is where you'll probably see IT violently move up. Is it going to happen in the next 2 3 months? I don't think so. Could it happen in a 12-month to 18-month time frame? There's a possibility of that, right? Given that valuations have also come down. The classic question here is, well, one of the larger companies in this space who of course downgraded guidance. Is that downgrade of guidance sufficient enough? Is 1 to 3% growth sufficient enough? Or are they going to be -1? Right? That's what the market is looking at this juncture.
Okay, Venu, great to have you on the show. Thank you so much, as always, for taking the time out and sharing with us your thoughts.
Thanks.